Now we discuss lecture number 19. We discussed trends and trend lines in detail in the past lectures. Now there is a new way to identify the trend or confirm the trend along with some confirmatory tool. The tool is known as moving average. In a simple language, if I want to know the price direction of any stock, I have three methods. First is trend series, another one is trend line and channels, and the third one is moving average. So let's learn the moving average in detail. Most of the people ask from me what is a moving average and why we use moving average to confirm the direction. Stock price can be very volatile, and to tackle this phenomena we use moving average, which smooths or smooth out short-term fluctuations and highlight the long-term trends and cycles. It means if a stock is volatile in a short-term nature, we smooth out with the help of moving average. We better known that the average price are more smoother than the real-time price. There are many type of moving averages like simple moving average, exponential moving average, weighted moving average, triangular moving average. But most of the investors and traders will use mainly two forms of moving averages. One is simple moving average, which is applicable to short-term data, and the exponential moving average, which is applicable to long-term data. That means in the short-term data, the price is less sensitive or more sensitive, then we simplify with simple moving average. In the long-term data, the averages become lagging, so we use exponential moving average, which is much more near with the recent prices. A moving average in a stock market context is an indicator that shows the average value of security price over a period of time. Why we use a moving average? Because moving average is based on the basic principle of mean reversion. What do you mean by a mean reversion? In a simple language, when the current price is deviate or move very strongly in one form of price direction, then it is away from the average price. And many of the statisticians and analysts think that if the price is far deviate from the averages, they again come to the average price. This concept is called as mean reversion. Moving average is based on the assumptions that both a stock high and the low price are temporary in nature, that a stock price will tend to move to the average price over a period of time. All moving averages are lagging indicators and always behind the current price. Moving averages are lagging indicator. They fit in the category of trend following indicators. As we discussed in the past lectures, there is a form of trend following trading strategies, and most of the trend following analysts are use moving average as a main important parameter. When price are in trending, moving average are work well with the price movement. However, when the price are not trending, moving averages can give you misleading signals. Now we discuss the type of moving average. We mainly discuss two main form of moving average in this lecture. The first one is simple moving average and the another one is exponential moving average. So we first discuss simple moving average. A simple moving average is formed by computing the average mean price of a security over a specified number of period. Let's explain in simple language. For an example, if I want to calculate 5 days simple moving average, then we adding the closing price for past 5 days and dividing by the number of days. By an example, if the closing price of past 5 days is 10, 11, 12, 13 and 14, and if we total that all 5 data, that is comes to 60. If we divide this 60 by past number of period, that is 5, then the average price of today is 12. Most of the people or analysts think that the simple moving average will be used for short-term price movement. Now we discuss exponential moving average. Exponential moving average can be specified in two ways. Either you can calculate on percentage based method or you can calculate on period based method. A percentage based method has a percentage as its single parameter. A period based method has a parameter that represents the duration of EMA. In this method we use the period or duration based method. The period based method use the multiplier which is equal to 2 divided by 1 plus number of period. Here the n represent the number of periods. We use exponential moving average for the longer period of time, which give closer estimations to the current price.